Good afternoon, everyone, and many thanks for your interest. Please note that this webinar is being recorded. We therefore kindly ask you to keep the camera switched off as well as the microphones to allow a smooth webinar for all of us. For Q&A, please use the chat function. You can write in there anytime, and we will address the questions at the end of the webinar. So finally, we did it. After 12 and a half years of frustration, of up and downs, we broke out into a new structural bull market on gold. This seminar addresses not only the gold case, but also the implication that has on other asset classes like bonds and equities. Let's start with the new structural bull market and the proof that we finally did it. Gold did it, and unexpectedly for most people, because investors are still selling and have been selling gold for the last kind of 2 years. Gold is finally breaking out, and it's a weekly close, so it's confirmed, and there is no question. It is also not comparable to the intraday breakout in late December among illiquid markets in Asia. This is the final breakout, and this is very crucial because, as you can see here, the gold market is behaving, since gold is freely fluctuating, which is in the early 70s, in major bull, respectively major bear markets. So the bull markets were the 70s and 2002 to 2011, while the bear markets were the 80s and 90s, as well as the period from the peak in 2011, September 11, until a few days ago. This is very crucial because it will make the life of our investors and ourselves a lot easier. Because as you know, the last 12 and a half years were not funny, especially not for gold mining investors. What's interesting is gold is breaking out while investors are still selling. As you can see here, there was a one-to-one correlation between the launch of the first gold ETF on this planet in 2004 until the middle of 2022. If you knew what investors will do the next 3 and 6 months, you knew where gold was going. However, since the freezing of the Russian foreign currency reserves, this game has changed. Emerging market central banks don't trust the US and the West anymore, and given the fact that they hold today between 95 to 100% in Western currencies like the dollar, euro, Swissy, Japanese pound, and English pound, they know if their government is not acceptable to the US anymore, they are done. So they decided to diversify and build up a position of 15 to 20% as a target allocation for gold to be less dependent on the US. Now, this will take them at least 10 years, probably more 15 years to get to this allocation, and are buying around 20% of the market. That means the gold price can now rise even if investors are exiting. The other big change on the gold side is China and India is buying around 2/3 of global gold. And these two countries have different trends right now, but both are buying more gold. Why is that? The Chinese savings rate is super high, and in the last 20 years, they put all their money, or pretty much all of their savings, into the real estate market. They know the Chinese real estate market is likely dead for the next 10 to 20 years. And given that financial products in China were also horrible for investors, they are starting to move into gold. India is currently flourishing and the economy is doing extremely well. And we know from historical analysis that if India is doing well, the gold demand in India is rising as well, as it does currently. So the momentum of the outflows from investors, thanks to the breakout, will soon change into inflows. So that means central banks want to buy gold, Western investors want to buy gold, the Chinese saver and Indian saver want to buy more gold. So it can only mean much, much higher gold prices. From an economic point of view, It's interesting that we see a change in inflation trends. As you know, we have been very right over the last 4 years with our inflation forecasts. So as a result, we said in 2020 that interest rate inflation will go up a lot higher. In 21, when everyone was talking about temporary inflation, we said that is structural. In the 22, we said there is a temporary disinflation. This temporary disinflation patch is over now because the temporary disinflation was a result of the base effect over the strong dollar, over the goods prices, especially heavy deflation from China, is kind of over as well, and commodity prices falling sharply over again. So all these disinflationary trends, short-term cyclical trends, are reversing. You also see here at the bottom that planned price changes in the US are starting to go among companies, to go up again among companies, leading to more inflation. What's also interesting is there is no slack. Unlike 2010 to 2020, when there was massive slack based on the output gap, there is no slack right now. So this is why inflation is much stickier than what the world expects. From an economic point of view, we still expect for this year lower economic growth due to the declining fiscal stimulus. I mean, last year was just insane, the amount of deficit increase. It will be less this year. And also the decreasing momentum in consumer spending, given that most of the excess savings from the pandemic have been spent by now. So this means for financial markets, goodbye Goldilocks and welcome stagflation. But this is not only short-term the case, it is also, and this is very crucial because this is showing the fact that gold is breaking out on a multi-year period. These are also trends which will go on for many, many years. Unlike the neoliberal supercycle between 2010 and 2020, which was characterized by low and stable inflation, zero or negative interest rates, which really resulted in everything bubble except gold and commodities. The big winners, because we have super low discount rates, were obviously long duration stocks, such as technology stocks, growth stocks, but also the broad equity indices, even real estate, cryptos, and other highly speculative assets. Now, the new super macro cycle is characterized by structurally higher inflation because structural trends, which have been highly disinflationary, are reversing to become inflationary. Starting with deglobalization. Globalization has brought us lower inflation and higher profit margin for companies. Deglobalization is the reverse. Due to the war between China and the US on global leadership, the deglobalization will not stop. Then for the last 40 years, thanks to the boomers, we had on average 2% too many people in the US for the labor market. Now, because of demographics, we are missing people, and this speaks for a tight, very tight labor market for many, many years to come, because too many people are retiring relative to the number of new entrants in the labor market. The third thing is also due to demographics, i.e. can't be reversed. An average human being saves money between 30 and 65. Before and afterwards, he outspends his income. Because of demographics, we are entering now, we have started to enter a new dis-saving cycle, which will just get worse and worse. So the world will more and more dis-save. Historically, and this is a big change because between 1980 to 2015, the world was savings more and more. Saving cycles, as we had for the last 35 years, have been highly disinflationary. This saving cycle, as we just started, have historically been highly inflationary. Then we have the commodity bull market, which is just starting in 2020 after 10 years of big declines in commodity prices, which were obviously highly deflationary. Now we have underinvested for more than 10 years in commodities, and commodity prices can only go up. Unfortunately, we also started a new war cycle, The trade war is just a start, is probably just a start, unfortunately, but war cycles have historically always been highly inflationary. Decarbonization, in addition to that, is again, given the investment needed, highly inflationary. So this is really the first time since 1980 that the balance of power is shifting away from the capital provider to real assets and workers. And therefore, investors should focus on themes that benefit from deglobalization, energy transition, and expansionary fiscal policy. But because we have structurally higher and more volatile inflation, these are primarily stocks with short duration characteristics, like commodity and value equities. We know how difficult the last 15 months have been for active managers, given the hype around AI. But reality, if that happens, this will lead to a revival of active versus passive management, making the job of active managers a lot easier than the last few years. So how do asset classes behave in this scenario? Because this is a completely different environment what we had in the last 40 or at least last 15 years. Starting with bonds, and this is very crucial because we hearing all the banks recommending long duration strategies. Fact is, if you look at US interest rates over the last 200 plus years, you see major cycles like bull markets, like the green ones, when interest rates are falling, and bear markets, the red periods here, when yields go up, which obviously has very negative implications for bonds, bond investments. Now, as you can see here, the shortest cycle ever on the bond market was 22 years. It's kind of funny that lots of investors, after 3 years of rising interest rates, believe that was it. That is unfortunately highly unlikely, and obviously higher interest rates is bad news for bond markets, for bond investments, but also for equities. Now, going to the equity market, it's also interesting what drives equities to a large extent. And the net profit margin is one of the most significant driver of equity returns. So what you can see here in the middle is the net profit margin on the S&P 500 since 1952. You see a major decline from the 65 to early 80s, driven by stagflationary environment, higher interest rates, higher inflation. Since 1980, we had a big boom in net profit margins going up around 3 times. In between 2000 to 2008, we had some kind of a decline. That was the commodity bull market. But what's very important, empirical research, one of the best, probably the best global quant house, number crunchers, took the 500 S&P companies, the profit and loss accounts, and they were looking, what's the reason, what were the reasons for this major increase in net profit margins between 2010 and 2021. So the shocking thing is, more than a third was based on lower interest rates cost, thanks to lower interest rates. The second largest, again, more than a third, increase in net profit margin was tax rates decline. Companies, especially tech companies, not paying any taxes, making all the profits in Cayman Island and other tax havens. The third largest impact was globalization, the benefit of outsourcing people to China, Bangladesh, and to have a lower capital intensity thanks to outsourcing to cheap countries. The shocking thing is only 6% is thanks to wage savings, i.e. efficiency gains in the US. So we have now a very interesting situation, and unfortunately very negative situation for global equities, because interest rates, as we just saw, are changing upwards for the next at least 15 years, which means companies will pay higher interest rates going forward. tax rates decline will also be hard achieved because we have now global minimum taxes coming in most countries and globalization reversing towards deglobalization. Now the market hopes for a wonder that this 94% tailwind, which is becoming headwind, will be compensated by 6% like AI benefits. Highly unlikely. Now, what's very crucial, when you look at the net profit margin here in the middle, when the margin was exploding, you had to be long equities, S&P 500. However, when the margin was shrinking or flat, you had to be in the minus. Why is that? The miners have not benefited from these tailwinds. They have hardly any debt. They could not put their profits into Cayman Island or other countries, so they're actually paying more taxes than ever before. And they could also not outsource their labor to Bangladesh or China. So given that these three things are reversing, this is highly negative for net profit margin on S&P 500, while the commodity sector is not affected by these trends. Now, looking back over the last kind of 100 plus years on Dow Jones, you actually see the same behavior as we have seen on the bond market. There are major bull markets and there are major bear markets. These are not 3 years or 1 year events. They are multi-year events. Now, what's interesting, the bull market for gold, and investors always forget that, the bull market for starts when the PE, and we have here the Schiller PE, normalized earnings, is very low. Then you have tremendous long-term returns. However, when the Schiller PE like now, or like in the year 2000, or in 65, or in 1929, is super high, it's one of the highest ever right now, the outlook for equities is very bad. In addition to that, the major bull markets in the equity markets were driven generally by falling interest rates and an increase in net profit margin. As we will see, just the reverse of that in the next 5 to 10 years, you can be relatively safe that unfortunately the outlook for global equities is very negative. Now, this is very crucial because the interest in global equities and the fact that people could make so much money with S&P 500 and other equities on this planet made gold miners hugely unattractive. Now, obviously, as money follows the trends, the price trends, given people will get out of equities in the next few years and will get into commodity equities, including gold miners, very crucial. Now, how is gold behaving in this new environment of rising yields? The general comment is rising yields are bad for gold. This is true in a Goldilocks scenario, but this is not true in a stagflation-like scenario, as we just started. Structurally higher interest rates and low growth. As you can see here in the 70s, gold went up with rising yields, fell with declining yields, and rose again with increasing yields. So the relationship between gold and interest rates reverses, like we have seen, for example, last year, as interest rates went up sharply and gold still went up by around 20% from the bottom. So very crucial, how can you protect your money, your investors' money, the wealth of your clients? Unfortunately, in stagflation-like periods, equities are bad, bonds are bad in the first phase, and real estate is bad. So a typical portfolio looks horrendous for the next few years. And the only protection for investors is gold, gold miners, commodity, and commodity equities. So unlike the last 12 years, when we might have had some diversification benefits, but generally, unfortunately, at the expense of much lower returns, this will be the reverse. Huge diversification benefits and very significant contribution to balanced portfolios. Another reason to look at commodities is when should you go into commodities? It's actually quite easy if you do it on a multi-year period. You should just look at two major things. First of all, the mining industry has to have underinvested for many, many years, as they had. Also in 99 when we started with Gold 2000, early 70s and now. And when the institutional money is out of gold and commodities, which is the case now. When should you exit your position? Probably in 7, 8 to 15 years. I can't tell you yet when that will be, but it will be a period of massive overinvestments for many years of the mining industry, plus huge interest from the institutional investor side. We are far away from that part, and all that speaks for going long commodity equities, including gold and gold miners. Now, who benefits the most from this new macro environment? As you know, we are running for 25 years a gold mining funds, and what you know, in every bull market, our products have outperformed the peer product by a factor of 1.5 to 2.3 times. The same thing we see here. You also see the long-term track record here at the bottom, but this is very crucial. When gold runs, you are far better off with gold miners, especially with the Conwave Gold funds. If Conwave Gold Equity is too volatile for you, we can recommend you as an alternative the Conwave ESG Gold Fund, which exhibits a lower volatility and obviously is also outperforming in a bull market, but generally also outperforming in a bear market. So the question is, what will bring investors back? First of all, obviously the more negative view on the stock market, which by the way, we are using time cycles from a very successful guy. And according to him, the peak in the equity market, this is a historical peak, so it's most likely, is between late February to July this year, before we entering probably a 10 plus year bear market on equities. But the other very relevant point is relative earnings revision. This will bring investors back. As you can see here, this is the last 5 years. You see here the earnings revision at the top left of gold miners, the earnings revision of the S&P 500 bottom left, and in the middle to the right, the relative performance of the fund versus MSCI World and S&P 500. What's very crucial, when gold is rising, gold mining earnings revision are exploding upwards. Especially that's crucial when there is a low growth period with kind of flattish to negative earnings growth. That was the case in 19 to mid-2020. Then we had a period of declining gold prices and cost increases, while on the broad market there was the strong economic recovery out of the pandemic, leading to massive upgrades on S&P 500 earnings, leading to major underperformance from mid-2020 to September 22. Then from September 22 to May 23, we had a gold price increase and rising earnings of gold miners, while there was fears about recession and negative earnings revision on the S&P, you had again an outperformance phase. From May until 2 weeks ago, you had kind of slightly declining earnings revision on gold miners, rising earnings revision on the S&P, and as a result, again, an underperformance of the gold miners, which is just starting to turn around because with rising gold prices, you can be sure that earnings revision of gold miners will skyrocket in the next few months, while with the low economic growth and the structural pressure on net profit margin due to the structural factors which are turning negative, you can expect at best flat, more likely negative earnings revision on the S&P 500. That is leading that quant investors, but also generalists are returning back to gold miners as we have seen in the last 1.5 weeks, and leading to a substantial outperformance of gold miners, especially Conwave Gold funds versus the broad equity indices. How much can you expect? We have symmetry in financial markets from a technical point of view over and over again. We see here 2 times minus 45, around 180% every time. So this is not the end of this bull market, but the next step, which just started kind of in September 22, but the major power wave has likely started kind of 10 days ago, should lead to around 180% on the index, obviously much higher for Conwave Gold, which based on the historical experience in 16 and 2019, 2020 should lead to $460 to $500 for the Conwave Gold Fund, which is a potential still well above 100%, most likely in an environment when general equities will unfortunately exhibit negative returns. I'm coming to the summary, and this is very crucial. Our base scenario is a soft landing, but stubborn inflation, i.e. stagflation-like scenario. What is very crucial and what we have seen before, in that environment, only gold miners, commodities and commodity equities protect investors. All the other asset class exhibit negative returns. But even should we be wrong and consensus be right, historically, when the Fed pivoted, like in 2008, like in 2016, when the Fed went from high rates to very slow rates, or in 2019, when the Fed pivoted, investors were coming back into gold, and gold miners provided investors with the highest return among all asset classes. So whoever is right, consensus or us, we strongly believe this year will be a very, very good year for our investors. And this is very crucial because, as we discussed before, we are starting a very challenging environment for bonds and equities investors, and therefore for balanced portfolios. While the outlook for gold is just greener than green, because we have a physical gold market where we don't need the investor anymore, but I'm highly convinced that the investor will come back in the next few months, because the macro outlook being either what we believe a more stagflation-like scenario, similar to Q1 22, when all our funds were positive in a negative equity environment, or even the pricing in of a final Fed pivot will be very bullish for gold miners. The miners themselves, after very tough 3 years, they are actually turning up. And now, as the very negative and cautious guidances for 2024 is out, i.e. all the bad news is out, we see now not only an extreme undervaluation relative to gold, its own history and other asset classes, but also a major turnaround in free cash flow and earnings, which will lead to investor interest. Behavioral finance point of view, it's just better than possible, because we are breaking out amid an environment of zero bullishness, total disinterest in gold and gold miners, high ETF outflow since April 22. Even the breakout was combined by further outflows. This is the idle breeding ground for an eminently important breakout in gold. And obviously, gold miners will be the way to play this, because now, as all the bad news is out, this asset class is really crazily undervalued. From a technical point of view, we expected it in the last few months. It finally happened. We have been breaking out of the multi-year consolidation phase, and we started a new bull market. So this is very crucial. And as you know, in all bull market phases, Conwave Gold funds have significantly outperformed physical gold as well as active and passive peer products by a factor of 1.5 to 2 times. So many thanks for your interest. I'm closing here on my webinar.